This is Chapter 2, Managerial Accounting and Cost Concepts. Learning objective number 2-1. Identify and give examples of each of the three manufacturing cost categories. So, the very first cost category is direct materials. We'll go on and define these further into the slides. Direct labor, and then we have the third, manufacturing overhead. Direct materials. This is raw materials that become an integral part of a product that can be conveniently traced directly to it. Remember, I say conveniently. So the flour for the dough could be conveniently traced to this bakery. Sometimes things aren't convenient, so that's when we are going to use something like overhead. Now, direct labor. These are the labor costs that can be easily traced to individual units. So, if we're talking about baking bread, the wages paid to the person baking the bread. Now, manufacturing overhead costs cannot be easily traced to specific units. There's such things as indirect materials and indirect labor. Materials used to support the production process, that is indirect materials. Lubricants and cleaning supplies to maintain the baking equipment. Although you know it goes directly to baking, you can't trace what amount of lubricant or cleaning supply was in that one piece of bread. Then we have indirect labor. These are wages paid to employees who are not directly involved in the production. Examples, the cleanup workers, the janitors, security guards. So they would be part of indirect labor, and that's part of manufacturing overhead. Then we have the classification of non-manufacturing costs. So selling costs are the costs necessary to secure the order and deliver the product. Administrative costs are costs that are all executive, organizational, or clerical. So the accountant would be in here, and the sales manager would be inside selling costs. So, product versus period cost. A product cost is direct materials, direct labor, or manufacturing overhead. It could be included on the balance sheet if all of this is part of inventory value, or when you sell it, it becomes cost of goods sold on the income statement. Period costs include all selling and admin costs, and they are expenses on the income statement. Another way to classify these costs, and they're often referred to as prime cost and conversion cost. Prime cost consists of direct materials and direct labor, whereas conversion costs consists of direct labor and manufacturing overhead. A conversion cost is the sum of the direct labor cost and manufacturing overhead costs. The term conversion is used to describe direct labor and manufacturing overhead because they are incurred in converting materials to finished goods. Now, understanding cost behavior patterns, including variable, fixed, and mixed costs. So, predicting or classifying a cost. So we're going to classify it as one of the three: a variable cost, a fixed cost, or a mixed cost. A variable cost is, in total, in direct proportion, it changes with the level of activity. So if you pay per text that you send, then that would be a variable cost. It's based on the number of texts that you send, if you pay 15 cents a text. I like the new updated BlackBerry on this, by the way. However, a variable cost is constant in some cases. The cost per text is sent is constant. So although a variable cost total would change, your variable cost per unit would remain the same. That is the 15 cents per text. So per each unit, variable costs remain the same, but as the number of texts go up, so does the total variable cost. Now, activity-based. So these are what are considered our cost drivers. A cost driver could be the units produced, if we are producing something, or it could be miles driven if we are a trucking company, or it could be labor hours, or it could be machine hours. This is a measure of what causes the incurrence of a variable cost. So when does the variable cost, so with each mile driven, does it go up? With each unit produced, does it go up? With each machine hour? And you want to pick something that fits, that's easy to track when you're setting up your cost. We'll get further into that. A cost that remains the same is a fixed cost. Regardless of the changes in the level of activity, it is fixed. However, on a per unit basis, the average fixed cost varies inversely. The more units you produce, the less per unit that the fixed cost. So example, if my rent is $1,000 a month, then if I produce one cell phone, that is $1,000 in fixed cost, so $1,000 per unit. If I produce two, my fixed cost just went down in half, $500 per unit. So fixed costs remain the same. They don't vary individually with the number of units, but if you were to divide it, the average fixed cost does vary. And that's a curve. So as the number of units go up or the monthly minutes used, the fixed costs go down. So there are two types of fixed costs. What we've considered committed, long-term, cannot significantly be reduced in the short term. Depreciation on building, equipment, and real estate taxes. We can't really do much about these. Then there's what's called a discretionary fixed cost, which means we could alter it by short-term managerial decisions. We could spend less on advertising or research and development. We're not binded like we are on the building, equipment, and real estate taxes. This is an overview. I'm going to do a separate video from chapter 2 that will show you examples of how to apply this.